G'day everyone, welcome to the video. In this one, we're going to be discussing what countries in Asia do not tax capital gains. So first up, when we're talking capital, what are we talking about? Well, we are talking about the sale of a capital asset. It could be property, it could be shares, it could be crypto, something like that. We're not talking about regular income here. And the other thing is, it's pretty much impossible to get into the details of everyone's different financial situation of every different country in this video, but what this video will do is give you some ideas of how things kind of work, how the country's tax laws may affect your situation, and then you'll be better placed to determine what the next steps will be if you are going to have the sale of a capital asset and if you are located in Asia. A lot of this will come down to whether you are a tax resident in a particular country. So if you're in Thailand, you could be a tax resident if you're there for 180 days. In Malaysia, you could be a tax resident there if you're in the country for 182 days in a particular tax year. The other thing is, are your assets onshore? Like if you're living in Thailand, are you selling assets located in Thailand, or are they offshore? Again, if you're living in Thailand, are you selling assets that might be located in the US or Europe or Australia? So depending on your tax residency status and the location of your assets will change things dramatically. So just keep that in mind. And lastly, there may be a double taxation agreement in place that may affect how your assets are taxed in this country like Thailand or Malaysia if you are located there. So every country, if you do have a double taxation agreement between your home country and your residence country, they can be kind of similar, but they will not always be so, and there always will be little differences between them. For example, a taxation treaty might set out which country has the right to tax a physical asset like property. Now, if you do want to learn more, if you want to sit down and have a chat to us, if you want to do a bit of tax planning around your capital assets and how you may be affected, you can head over to our website, offshoreinasia.com, book in a call there, and we'll do what we can to step you through your situation and keep more of your money in your pocket. So first up, Thailand. Now, Thailand doesn't have a capital gains tax as such, but they do tax capital as ordinary income, kind of like job income. However, it depends on what the capital asset is. So if you have shares that are located in Thailand, on the Thai stock exchange, they can be tax-free. Also, shares that are located on stock exchanges of other ASEAN countries, they can also be exempt from taxation. Now, as far as offshore gains go, in the past that was tax-free. That is coming into question now with the new foreign sourced income tax interpretation that came into effect on the 1st of January 2024. So we don't know yet whether remitted income of capital proceeds will be taxable in Thailand. There is a chance it might be. I would encourage you to sit down with a tax advisor in Thailand. We can help to put you in touch with someone if you wish, if you are planning on selling a capital asset and you are a resident of Thailand. Malaysia. As far as taxing capital goes in Malaysia, they have what they call an RPGT, a real property gains tax. It's pretty much a capital gains tax, and depending on how long you hold an asset in Malaysia will determine the tax rate that you pay. For example, citizens and permanent residents, if you hold an asset for up to 3 years and then dispose of it, you will pay 30% tax RPGT on the gains. Now, if you hold the asset for more than 5 years and you are a citizen or a permanent resident, there is no RPGT, so that is very attractive indeed. The situation is slightly different if you are not a citizen and not a permanent resident. If you hold the asset for up to 3 years, you will be taxed at 30% of the gains. And if you hold the asset for over 5 years, you'll only be taxed on 10% of the gains. So still very attractive for a non-permanent resident in Malaysia. When it comes to taxing offshore gains, in the past that has not been taxable in Malaysia. They are changing their rules in 2026, but still then you should not have to pay tax as long as that income is not remitted into Malaysia. But again, if you are planning to sell a taxable asset, I would strongly encourage you to sit down with a Malaysian accountant who can work through this to make sure that you will not be taxed if you are a resident of Malaysia. We have partners in Malaysia that can help you to do that. So again, if you want to learn more about that, you can book in a call on our website and we can get the process started. Depending on what visa you are on in Malaysia can determine your tax status as well. For example, as I was saying just before about the taxation rules changing in 2026, what I'm talking about there is the Malaysian Income Tax Act. So how residents are taxed in general in Malaysia. But if you are on a visa like the MM2H, there is often a carve out that will exempt you from foreign sourced income taxation. So depending on what visa you're on will determine your tax status, whether you're taxed under the special rules of the visa or whether you're taxed under the broader Malaysian Income Tax Act. Next up is Singapore. Singapore is one of our favorite places for putting our money in Asia. It's not necessarily a place you would go to live just because of the cost of living is quite high, unless you are working locally on a local salary, of course, but it's a very good place to store your money. Whether you're looking for favorable taxation, access to the rest of Asia, asset protection, world-class precious metals vaults, Singapore has all of these things. And the best bit is there is no capital gains tax in Singapore. If you are interested in how you can capitalize on this and either store precious metals in Singapore or set up a brokerage account that will have access to all of Asia, hit us up over on our website. I'll put a link up above as well. We can help you put these things in place and get your money working for you in one of the premier wealth management hubs of the world. You do have to have a bit of money to make it work, but you don't have to be a millionaire. Next up is the Philippines. If you have a capital gain, a locally sourced capital gain, so you sold some Philippine shares, maybe you had these shares as part of the SIRV, the investment visa that gets you residency into the Philippines. If you sold these shares and made a gain, it will be taxable. However, if you are a resident of the Philippines, provided you're not a citizen, offshore capital gains will not be accessible. Now, Hong Kong is also a big wealth hub of the world, just like Singapore. Whether or not you are comfortable storing large sums of money in Hong Kong, that is for you to consider. If you are comfortable, then Hong Kong can be quite a tax favorable place as well. There is no tax on capital gains in Hong Kong, provided that your sales transaction is not considered to be trading and therefore would be assessable for profits tax. But generally, the sale of capital assets are tax-free. The last country I'll mention here doesn't get talked about a lot, but it's worth a mention. It is Laos. They do not have a capital gains tax as such, but they do tax the proceeds of a capital transaction, and that's taxed at 2%. So when I say proceeds, what I'm referring to here is the whole amount that you sell an asset for, not the gain, which is the difference between the buy and the sell amount. So it's 2%. That could be a large amount if it was a large sale, but still that 2% can work out to be a lot less compared to some other countries. Australia, for example, if you're in the top tax bracket, you might be on the hook for 47%. You would get the 50% capital gains tax discount there potentially, but it still might end up being a lot more tax in a place like Australia or the US than you would pay in a place like Laos if you were a tax resident there. So I'll wrap the video up, guys. Like I was saying at the top, there are many nuances that can be involved here, whether you are a resident, whether you're not a resident, if your asset is held in the country where you are living, or whether the asset is held in a different country, an offshore asset. These will change the way the tax is treated for your particular situation. Now, if you are contemplating selling a capital asset and you might be living in one of these countries overseas and you're not sure how that may affect you, I would definitely encourage you, especially if it's a big asset, if there's a lot at stake here, to get advice on that. We can help with that if you like. So if you want to talk to us, you can head to our website, offshoreinasia.com. There's a button in the top right of the screen where you can book a call with us and we can go through your tax situation and the best way to proceed thereout. Thanks a lot for watching. Keep your tax dollars in your pocket and we'll catch you later.